Right, up next are the investing decisions, and we have three specific investing decisions that we have. Number one, capital rationing. Number two, asset replacement. Number three, lease or buy. But mainly, what we are going to be doing today is that we are going to focus mainly on the capital rationing. That is what we are going to look at as one of the three specific investing decisions that we do have here. All right, let us look at capital rationing. What is capital rationing? How can we define capital rationing? So, capital rationing occurs when we have insufficient capital for the investments that we intend to undertake. That is capital rationing. All right. We may define capital rationing as the limitation to the maximum amount available to invest in all projects with positive NPVs. Right. In other words, we are saying the organization cannot invest in all the projects that have been identified. So the projects with positive NPV are the projects that we have identified. So let us look at two types of capital rationing. So the types of capital rationing, in other words, we are saying what are the causes. So the causes of capital rationing are defined or are divided into two. The first one is hard capital rationing. When we have hard capital rationing, we are saying it is the external environment which causes us not to get the intended funds. The funds that we want to raise, we can't raise them due to the external environment. So we can define that as when the company cannot raise enough capital due to the external factors. And what are these external factors? We have economic factors generally. We might want to borrow money from the bank, and banks are not willing to lend money. Why? Because maybe the business environment is volatile. There is much risk. All right, or even in the money market, we do not have much money. The lenders of money are not quite more. Then B, we have lack of collateral security. This is collateral security. That is what we call asset security. As you may know that every time you borrow money from the bank, you should pledge a certain asset or certain assets as collateral. If you do not have such collateral, you can't get the money. All right, you can't raise enough money. Then C, no track of record. So in order for you to borrow much money, you should have a credit history. Have you borrowed before? If you haven't borrowed money before, it means that the amount that you want to raise may not be the amount that you get if you go to the banks. And next one, we can look at the poor management team. So the lenders would want to know probably the qualification, expertise, diversification in your organization, right? If that is deemed to be poor, then the banks or the lenders of money may not really stretch much in terms of giving you the money as an organization. We might also have the government policy, the government regulation. It can also limit the maximum amount that we can borrow. So these are the external causes, which is what we call hard capital rationing. Moving forward and look into another type of capital rationing, we call it soft capital rationing. When we have soft capital rationing, we are saying now it is the management internally which is going to put a cap on the amount of money that we putting aside for investments. So funds available are restricted by senior management. We might, for example, want 10 million, but management would say probably we only have 5 million to invest into long-term projects. All right. The main challenge of soft capital rationing is that it is contrary to the shareholders' view of wealth maximization. What does that mean? The urgent principal problem. When the when the management is employed, their duty, amongst others, is to make sure that they increase the shareholders' value. But if you limit what we can invest into, it means that the shareholders' value is not maximized. That is the challenge with soft capital rationing. But well, what could be the reasons an organization might put a cap in terms of money that can be invested in long-term projects? Number one, we might have a wish to concentrate on relatively few projects. We might not want to have a wider pool of investments. We just want a few projects. Probably we can manage them well there. All right. Unwillingness to take external funds. So we might not want to go out there and probably raise money through debt or sell shares to the stock market. We just use what we have. Another item C there is willingness to concentrate on strongly profitable projects. So sometimes we might assess the projects. Of course, they are all viable. They do have a positive NPV. We might not undertake all of them. We just choose those ones that are topping in terms of profitability. Right, management may lack the expertise to exploit all available opportunities. We might have identified a number of projects, but some of them we are not in a position to run them. So another item there, which I think I can add on, another note. Let me just do this. If I may add another note, is that when management is risk averse, right? When management is avoiding risky projects, right? So when they are avoiding the risky projects, we call them risk averse. So if management is risk averse, out of the projects, if we do the risk assessment, we are going to avoid those projects that we deem or we see as much risky there. All right. So this is what we have in terms of what causes us not to have enough money to invest into the projects with positive NPV. Now, capital rationing may exist in a single period. So we might have what we call a single period capital rationing or multi-period capital rationing. So our study here mainly is going to look at single period capital rationing. So let us look at a single period capital rationing. What does that mean? It means that we want to invest. We have opportunities today, but we have a short of capital now. So this occurs when funds are in short supply in the current period. So 1 year only, but well, if we are to say that correctly, we are saying the limitation of funds is now, which is year 0. So we have assessed our projects now and we want to invest into them now, but we do not have enough money. That is a single period capital rationing. So it occurs now, but the funds will become available in year 1, which means that after 12 months we now have funds to invest into these projects that we have identified, okay? But challenge is that we are going to look at these assumptions here. If we don't undertake the project today, right, the opportunity is lost. So it's either we invest now or we don't invest at all. The opportunity is going to be lost if we can't invest now, right? The risk and uncertainty and strategic importance of all projects is the same. So these are the assumptions of single capital rationing. So it's either we are investing now or we are not. So if we do have more projects, what does that mean? We are going to make the selection of projects now and we leave the rest, okay? That is what we are looking at there. Let us look at what we call divisible projects. Under capital rationing, we do have some projects which we may call divisible projects. What is a divisible project? A divisible project will allow us to have what we call a partial investment. You can do any amount of an investment and you get a proportional amount of NPV. Right. So I may explain that using this point here. Divisible projects can be made in a portion between 100, 0% to 100%. Right. So what is it that we're saying here? Let me just give a quick example so that you may understand this one better. A good example is that a project, a divisible project, right? A divisible project requires 10,000 as initial investment, right? The project's NPV is 6,000, for example. All right. If we invest 10,000 now, we are going to have an NPV of 6,000. So this project is a divisible project. So in a divisible project, we can invest any amount that we have and we get a proportionate NPV. Right. If only 3,000 is available to invest, 3,000 is available to invest, right? What is NPV? What is the expected NPV from this one? So the total amount, 100% of the investment is 10,000, right? Where we could get 6,000, but we only have 3,000. So how are we going to calculate the NPV of this divisible project? So we are going to say, okay, what is it that we have? We have 3,000 into full amount required, 10,000, okay, multiplied by the full NPV, 6,000. So if we invest the 3,000 that we have, our NPV is going to be 1,800. That is a divisible project. So whenever we are solving problems of capital rationing, we have to understand first whether a project is divisible or not. If it is divisible, whatever the amount that is left for the next investment, we do this, okay? I'll explain that as we proceed. Right, when we have divisible projects now, what is it that we are going to do? Remember, our capital is not sufficient. If capital is not sufficient to invest into all the projects that we have, and the projects are divisible, this is the solution. If projects are divisible, solution comes through profitability index. What is a profitability index? Is the ratio of the net present value of our project future cash flows that have been discounted at the current cost of capital, right, and the initial amount that we require to invest into that project. So this is the formula that we use to determine how profitable is a project here. All right, profitability index is equal to net present value of the project here. All right, let me say NPV of a project. So first thing, we have to calculate net present value of a project. We divide by the initial investment, right? And we are going to make use of this technique to compare a number of proposals or projects which involve a different amount of initial investment and also different amounts of our NPVs. Okay, that is what we do. So we have a problem here that we need to look at, and we are going to assume that the project is all these projects are fully divisible. Capital for investment is limited in year zero. Year zero means now. That is single capital rationing to 5,000. There are 4 investment projects available with a positive NPV. All of them do have positive NPV, but these require a total of 10,000. Here's the challenge. We want 10,000, but we only have 5,000 for investment. The investment required for each project and project NPVs are as follows. So investment in year zero, we have project A 5,000, 2,100, 1,400 and 1,500. Net present value are given for each project here. Which project should be selected for investment in order to maximize NPV? Right, so what is it that we are going to do? First of all, we are going to assume that all these projects are divisible. So these are the steps that you are supposed to be undertaking. Right, first of all, if to say the NPV of our projects are not given here, if our NPVs are not given, first thing, we were supposed to calculate net present value of cash flows. Remember, here it is net present value. If you are given present value, so NPV, you are going to have NPV is equal to PV minus initial. So in most cases, you might have a question where you just have the present values of project. So you need to then subtract the initial amount from that PV in order for us to get to the net present value. That is step number 1. Step number 2, calculate the profitability index, where you are going to have your investment divided by your net present value divided by the initial investment there. You are going to rank the projects. How are you going to rank these projects? We are going to rank a project with highest PI is the most profitable, right? With highest PI ranks first. All right, so we are going to rank in a descending order. We are going to assume that highest PI is the most profitable, and then at the end of the day, determine the investment decision. So our decision is a decision that maximizes NPV. So our main goal is to fetch as much profits as possible in terms of net present value. Now, having this as a challenge, let us bear in mind that what is available is 10,000. Let us copy this one down so that we can have a solution here. Right, so these are the projects that we have. Next, first step was to calculate net present value, right, of each project. Step number 2 was to calculate profitability index. Since the net present values are given, we are going to calculate the profitability indexes first. So we are going to have net present value divided by the initial investment, 1.25 up to the end there. So we do this. That is step number 2. And then step number 3, I'm going to rank my projects, rank using PI. Which project is going to rank first? I can see that B has got PI of 2 and it is topping there. That's number 1. D is number 2. Then we have A number 3. We have C number 4. So our investing decision is going to take, we are going to follow the ranking order in order for us to determine our investment decision here. Right. Now we are going to have optimum investment plan. Optimum investment plan here. Right, our optimum investment plan. First of all, we are going to have what is available. Let me have this. All right, available capital. That is what we want to make use of. We have 10,000. That is what is available. All right, first thing is for us to invest into project B. Project B requires how much? B requires, the initial investment for B is minus 2,100. So from that capital we are going to reduce 2,500. What is going to be my balance after investing into B? My balance is what? Alright, so let me just add like this. I have 7,900. So let me just write on top the capital and what is going to be the NPV, because our solution should also give us the resulting NPV. So from this project that we have invested, the net present value is 4,200. All right, I go to the next. After determining my balance here, right, I need to deduct the amount required for project number D. Project D requires how much? Equals minus 1,500. What is going to be the balance after investing into project D? I can just copy this here and paste it there. All right, I have 6,000. I have 6,000. Is that correct? I have 6,500. Is this correct? Project D. Where is my project D? Okay, that's fine. I have 6,400 that is remaining. And what is the resulting NPV? That is 1,950. And then I go to project. Not really. That is not really correct, because what is available is 5,000. My apologies for that. It was not 10,000. Yes, this is now correct. What is available is 5,000. After investing into B and D, we have 1,400 that is left. And then the next project that we can invest into is project A. Our project A do require how much? Project A requires 6,000. 5,000 to invest. We need 5,000 for project A, but what is available is only 1,400. Since we only have 1,400. It is not enough to invest 100% that is required in order for us to realize an NPV of 6,250 here. So what we are going to do is to utilize what we have and see how much NPV we are going to get. So we are going to make use of whatever that is available, 1,400, such that the balance that we have at the end is 0. So if I invest 1.4, a project that required 5,000, I only had $1,400 into 5,000 multiplied by the NPV of 6,250. Enter. I get 1,750. So our resulting NPV, if we have divisible projects, we are going to get 7,900 as the resulting NPV, and I'm going to have 100% investment into B, 100% investment into D, and a partial investment into project A. This is how we solve questions to do with divisible projects and under capital rationing. All right, let us quickly move on and look at what we call non-divisible projects. So a non-divisible project is a project that cannot allow a partial investment. A partial investment is not allowable. So it's either you are investing 0% or 100%. So in other words, we are saying it's either you are investing all of it or not at all. Partial or part investment is not feasible, is not possible there. The selection of investments should be those that offer maximum NPV with the capital that is available. That is the goal in mind, okay? Finding the combination that then maximizes this NPV is a matter of trial and error, testing all possible combinations of projects that can be undertaken with the capital that is available. This is what we want to be looking now when a project or when projects are non-divisible. That is what we want to look at. Right, assuming we still have the same challenge, the same question that we had above, and our project again, our projects are non-divisible. We now have non-divisible. Capital required is 10,000. We only have 5,000 available, and we have 4 projects here. Let me name them A, B, C. B, C, and D. Right. So these are the projects. Nothing has changed. So what we need to do now is to do a try and error. Let's have the combinations that we can have here. So we want combination, right? And after combination, right, we need to know how much investment is required in total and what is going to be the resulting net present value. So we are going to choose a combination with the highest net present value. Let me just do this here so that it's visible. All right. I can see that project A would require the total amount. So project A itself is a combination. Project A requires 5,000, which is what we all have, and the net present value is this one. And then we try another combination. Let's see if we do B, C, D. Let me just try here. If I add B, C, D, how much capital? Yes, that's 5,000 exactly. So project B, C, and D, they require 5,000, and what is going to be the resulting NPV for this combination? We have 7,690. What does that mean? it means that we are going to choose this combination as it results in highest NPV as compared to us just undertaking project A alone. So this is what we do when projects are non-divisible. All right, I'm going to go back and assuming, for example, I'm going to assume that we had capital available of 5,500. Assuming we had capital available of 5,500. Under each option, you would see that there was going to be 500 left. If we use project A, it uses 5,000 and there is 5,500. There is 5,500 available. 500 excess. That excess couldn't be invested in anything, so we leave it. Same applies here. We were going to be left with another 500 that cannot be used for anything else. We could leave that. Okay, that is non-divisible projects. So let us look at a situation whereby we have mutually exclusive projects. So in a case where we are told that we have mutually exclusive projects, these projects cannot be undertaken together. An example could be example is that A and project A and E are mutually exclusive. Mutually exclusive. What does that mean? It means that our project combinations of A, we do not find E there. The project combinations with E, we do not find A there. But all other projects can be chosen to either side. That is what we mean under mutually exclusive projects. So when we have mutually exclusive projects, whether it's divisible or non-divisible, these two projects cannot be undertaken together. All right, thank you so much, guys. Meet on the next chapter.